Chapter 21, Cost, Volume, Profit Analysis. Okay, in this presentation, we'll compute contribution margin, the contribution margin ratio, and the unit contribution margin, and we're also going to look at break-even point and the sales necessary to achieve a target profit. So this is probably the heaviest part of the chapter right here, and we'll do a lot of problems together that'll help clarify this for you. Now, CVP is the examination of relationships between selling prices, sales and volume, costs, expenses, and profits. All right, it's one of the really most useful thing that you can have in a business. And some of the ways that it may be used is to figure out the effects of, well, what if I change my selling price? How will that affect my profit? Or analyze the effects of changes in costs on profits or in volume on profits. Setting selling prices, selecting the mix of products to sell, okay, or choosing among marketing strategies. So you can see how all of these things would be really important to any business. And cost, volume, profit analysis lets you do that. Now, the contribution margin is the excess of sales over variable costs, which is computed as follows. So sales minus variable costs is contribution margin. Okay? And just think the contribution margin covers your fixed costs. Okay? It's a contribution toward covering your fixed costs. Once the fixed costs are covered, any additional contribution margin increases income. Okay? So let's look at an example. Here is this Lambert Inc. They've got 50,000 units. $20 per unit is their selling price. The variable cost is $12. Okay, so you can see they're making $8 per unit in contribution margin here, but their fixed costs are $300,000, not a small piece of change. So here is a contribution margin income statement format, and what this does is it moves your variable costs up to the top and your fixed costs down below. So costs are organized by cost behavior rather than cost function. So we put variable up here, which means a direct relationship to sales, okay, variable, and our fixed costs down in the bottom. So our variable costs here are $12 per unit. He's selling 50,000 units, so our contribution margin then would be 50,000 times 8, or 400,000. Fixed costs are 300,000, so our income from operations then is $100,000. Okay, so we needed $300,000 of this contribution margin we needed to cover our fixed costs. Okay? Now the contribution margin ratio is a really handy formula. It's also called the profit volume ratio, and it indicates the percentage of each dollar available to cover fixed costs. So if I took, here's Lambert, I've got the 400,000 in contribution margin divided by $1 million in sales, okay? Contribution margin divided by sales, that gives me 40%. So then we can say that 40 cents of every dollar goes to covering fixed costs. And what's good about this is you can compare this to other industries, to your company in earlier years. Once you've got a ratio, it's just more easy to work with, especially when you're trying to compare things. Like maybe to the industry, what does the industry do here? It's most useful when the increase or decrease in sales volume is measured in sales dollars. So in this case, the change in sales dollars, so I could take this change in sales dollars, multiply it times the contribution margin ratio, and that will give me the change in income from operations. Okay, so that's very handy. So if you add $80 in sales, because you've got sold more units, you can multiply that 80,000 times 40% and get $32,000. That's how much income from operations is going to change. Okay, now if we need to do a lot of exercises here, so make sure you do the class exercises so that you get to see how this works, okay? And here's the contribution margin ratio statement from Lambert. It's a little bigger. They've got $1,080,000 in sales. Here's our variable cost. We sold 54,000 units at $12 per unit, or $648. So our contribution margin is $432, less the fixed cost, means income from operations is $132. Okay, just like it said. Now, the unit contribution margin is useful for analyzing the profit potential of proposed decisions. Like if their selling price is 20 and their variable cost is 12, the unit contribution margin is $8, right? So the unit contribution margin, okay, is most useful when the increase or decrease in sales volume is measured by sales units. So in this case, the change in sales volume multiplied by the unit contribution margin equals the change in income from operations. So change in income from operations is equal to the change in sales units. Okay, so we went with this in this example, it's going up by 15,000 times the unit contribution margin, which is $8 per unit. So what we're looking at here is earlier what we did was we looked at the contribution margin ratio, the 40%. Now we're looking at what if I take just the unit contribution margin itself. That will give me the change in sales dollars. Okay? Or not change sales dollars, but change in income from operations. So 15,000 more units times my contribution margin gives me the increase in operations from the additional sales. And here's the confirmation of that. Here were my sales, 65,000 units. We had 50 before, now we've got 65. Here's my variable cost, 780,000, minus my fixed cost. Now my income from operations is 220. Now let's start looking at some of the formulas we can use here. And the first one would be break-even point, and that's the level of operations at which a company's revenues and expenses are equal. So at break-even, a company reports neither income or loss, okay? So now the real tricky part here is at break-even, the contribution margin is equal to your fixed costs, okay? That's always a tricky multiple choice question. Let's get a, okay, well, just think about that. At break-even, I can put it here. At break-even, the contribution margin is equal to fixed cost. Okay? So break-even sales then would be if I take my fixed cost and divide it by the unit contribution margin. That'll do it. So at break-even, my revenues equal my costs. All right, we just complicated a little bit when we divide it up between variable costs and fixed costs. Actually, that gives us a lot more power in our analysis. So here's an example for Baker Corporation. We've got fixed costs of 90,000. The unit selling price is 25,000, or $25 per unit, and the variable cost is 15. So the unit contribution margin is 10. Okay, now what you want to do, if I were you, is I would stall the video and then write down these numbers and work it through yourself so you can really see it. Otherwise, it's just going to sort of go over your head. So the break-even point for Baker is computed as follows. So here's break-even. Fixed costs divided by your unit contribution margin will give you break-even in units. Okay? So 90,000 in fixed cost divided by the $10 contribution margin gives us 9,000 units. Okay, and that would be our break-even. okay, in units. So if I sold 9,000 units, so it'd be 9,000 times $25. That would give probably, yeah, that would give me $90,000. Okay, that would be my break even, because my contribution margin then would be equal to my fixed costs. Okay. Now here's the verification of it. So here's our unit sales, 9,000 times 25. Variable costs are 9,000 times 15. So the contribution margin is 90. And then fixed costs are also 90. So we just broke even and income is 0. So here's the break-even point in sales dollars. You can also take it and divide it by the contribution margin ratio, okay? The contribution margin ratio will give you break-even dollars. That's the important part, okay? So if I want break-even units, I use the actual contribution margin here. If I want break-even sales dollars, then I'll use the contribution margin ratio. Don't forget that sales dollars too. Okay, so the contribution margin ratio can be computed using the unit contribution margin and the selling price as follows. So here's our contribution margin ratio. I can take my unit contribution margin divided by the selling price, and that gives me my contribution margin ratio. So use an easy number, like if my contribution margin is 4 and my selling price is 10, then my contribution margin ratio is 40%. Okay, so the contribution margin for ratio for Baker would be $10 divided by the $25 selling price, okay, or 40%. So it's the contribution margin divided by the selling price. I think I said it. Did I say it upside down before? Oh, well. Thus, the break-even sales dollars for Baker can be computed directly as follows. So these are break-even sales dollars now, okay? That's your fixed costs divided by your contribution margin ratio, okay? Fixed costs over contribution margin ratio gives you break-even sales dollars of 225,000. So when I sell 225,000, then we'll be at break even. Now fixed costs do not change in total with changes made in the level of activity, but they might change because you change your advertising, property taxes change, supervisor salaries change, so they do affect the break even. If you increase your fixed cost, your break even is going to go up. And if it goes down, then your break even goes down. Okay? That makes sense though? You've got a bigger nut to cover, so you've got to sell more. Okay? Now, let's assume the bishop has a proposal to add an additional $100,000 for advertising. The data for bishop is as follows. So here's my current and proposed selling price. There's our unit variable cost and unit contribution margin. And in one case, our current fixed costs are $600,000. What if they change to $700,000? Let's see what happens. Before the additional advertising, our break-even is 30,000 units. So fixed costs are 600 divided by a contribution margin of 20 gives us 30,000 units. Bishop's break-even point after the additional advertising expense of 100,000, okay, would be, here's my contribution margin, or my fixed cost now, 700,000. I'll divide that by my same unit contribution margin of 20, and our break-even sales units then would be 35,000. Okay, so I know there's a lot to keep track of here, but you can do it. You just have to do a whole bunch of problems, okay? You just or do the same problems over and over again, it'll really help. So variable costs do not change with changes in the level of activity, but they might be affected by other factors, like your variable cost for direct materials might change, or the labor rate might change, or the commission that you're paying to salespeople. Changes in unit variable costs also affect the break-even point. If the variable costs increase, break-even increases. And if they decrease, break-even decreases. Okay? Just like fixed costs. And it's common sense. If you think about it a little bit, it makes sense. So here's an example now. Assume that this park is evaluating a proposal to pay an additional 2% commission on sales to its salespeople as an incentive to increase sales. So they want to pay the salespeople more. Right now, our selling price is $250. Here's our variable costs, and there's our contribution margin. Our fixed costs are $840,000. So if I increase our commission by 2%, then our unit variable costs go from $145 to $150. Now our contribution margin is lower, but our fixed costs are the same. So what's the effect? I go from having a break-even point with the additional 2% of 8,000 units, now it's 8,400 units, okay? We've got to sell a lot more, 8,400 units, okay? So another 400 units to cover that additional 2% commission. You know, but if your sales increase, if the salespeople do a better job, or if you keep your salespeople that you want to keep, then the commission would be worth it. So changes in the unit selling price also affect it. If you increase the selling price, though, break-even goes down, right? And if you decrease the selling price, break-even would increase. So it's sort of the opposite, but this, again, is common sense. Now here's a summary of all these changes. Personally, this doesn't help me at all. Yeah, I just have to think through it, and it makes sense that if your costs increase, your break-even is going to increase, and if your sales increase, then your break-even is going to decrease. Okay, I think that's nice and simple, and probably the best way to look at it. Now we've got one more formula here to look at that you'll use, is really useful, and that's calculation of a target profit. And this is where we don't want to break even. We want to earn a target profit. So all you do is add the target profit to your fixed costs. Everything else stays the same. For sales in units, I'll take my fixed cost plus the target divided by the unit contribution margin. And here's our example. I want to earn $100,000 here. So I've got $200,000 in fixed costs plus $100,000 in target profit. My contribution margin right now is $30 per unit, so I need to sell 10,000 units. Okay, if I sell 10,000 units, then we'll cover our break-even, our fixed costs, and we'll also earn a target profit of $100,000. And here's the proof of it here. Okay, you can see that it works though. And we're just about done. Here's another, using the contribution margin ratio this time. We've got the unit contribution margin divided by our selling price gives us a contribution margin ratio of 40%. So the fixed costs plus the target divided by the contribution margin ratio, okay, gives me $750,000 of sales that I'd need to break even. Okay, not to break even, sorry, to cover our fixed costs and also to cover our target profit. Okay, so you want to do a whole bunch of problems in these so you're really comfortable with it, and then go forward.